Now one sector which is doing fairly well for itself is the auto space. And we've seen the January numbers in terms of auto sales data come through, and some very, very strong numbers. Whether you're talking about CV, whether you're talking about PV, and therefore auto could well be a sector which will continue to remain in focus because the kind of growth numbers that they're posting is very, very strong. Now today, we're going to be talking about a company which is at the confluence of three key businesses. One is obviously the auto ancillaries business, which is a direct beneficiary of the auto cycle that we're seeing. The second one is the EV business. And e-buses is a big business given the fact that there is very, very strong order traction that we're seeing across the board. And third is with regard to battery and energy storage solutions. And because they are in that EV business, battery and energy storage solutions becomes a very critical component of the EV business itself, but they are diversifying into the solutions business as well. And therefore, it'll be critical to understand how they see the longer term runway with regard to JBM Auto. Now, the first one, the first piece of what I want to know is, growth trajectory, FY26 and beyond. They've guided for 6,000 to 6,500 crore of top line. I'm curious to know whether they achieve that or whether they exceed that and what happens thereafter in FY27. The second piece is with regard to capacity utilization. They have the largest single venue plant with regard to e-buses. I want to understand what's really hampering utilization. If they have such a large capacity, then the kind of order book that they have should see very good traction. So what's hampering execution and whether that can get ramped up? I'm trying to understand upside surprise from here with regard to that. The third piece is with regard to two key components which impact margins. One is rare earth, because that impacts both execution as well as margins. And the second part of that is also commodity cycle. And we've seen unfavorable tailwind where commodity cycle is concerned. I'd want to understand how that is playing out with regard to margins. The fourth now, I'll shift focus from OEM to battery energy storage and how large is the order book? What's the kind of traction that's building up over there? What are they doing in terms of products versus competition? I want to understand all of that and what kind of a revenue contributor will this be as a business to the overall top line, maybe a couple of years from now. The fifth piece is with regard to cash flow and whether that can improve at all. Viewers have not even come to the fact that the auto cycle itself is at the cusp of a turnaround, and therefore all the OEM players that are their customers could also be turning around in terms of numbers. So that too, there's just so much to talk about in terms of this one. Is there any scope for improvement with regard to cash flows? Because that has been a big drag when you're looking at it over the last 2 to 3 years. Conversion hasn't happened from EBITDA to free cash. Debt, it's gone up and it continues to go up. Can it normalize? At what levels? What are the expectations? Are they going to do an equity raise? The last piece is with regard to electric light CV. That's the other product that they're going to do. How is that shaping up? When is the launch? And how is competition looking like? All of that is what we'll try to get from JBM Auto. Mind you, they do no con calls, and therefore it becomes that much harder to try and get commentary and understand what the management guidance was. Now let's talk about the company, and we'll keep this very brisk. Leading auto components and e-bus manufacturer is what this one is. It was founded in 1983. It's part of JBM Group. It operates in auto systems, e-buses, tooling, energy storage. It's present in India as well as globally, even though the global component of the total top line would be roughly single digit, so very, very small. In terms of products and value chains, they are in auto component segment, chassis, suspension, skin panels, assemblies. They are into EV within the OEM basket. In e-buses, they are into city, intercity, luxury, staff, tarmac. They are into the whole host. The lighter CV, well, I'll be curious to know what that means with regard to the business itself. Tooling, it's again a very small component of the overall business, again single digit to revenue. But dies, molds, welding, and fixtures. There's an even Steven in terms of the revenue contribution coming in from EV. And e-buses and auto components. I wonder how that revenue mix also changes and how margins change as a result of that, if that were to happen. They're also now into energy storage and aggregates. Now that segment, there is high voltage lithium ion battery packs that they sell for vehicles. Battery management systems and vehicle control electronics is what they also sell, and battery energy supports storage systems for power projects. Now, mind you, this has become mandatory now under the new law. Whenever you set up a power plant, you have to mandatorily set up energy storage solutions along with it. So this could be a large opportunity for JBM Auto. In terms of the business, it's vertically integrated, steel processing to bus assembly, everything. It makes lithium-ion batteries, power electronics, and advanced software itself. In terms of the clientele, that won't come up on your screen, but Tata Motors, M&M, Aisha Motors, even companies abroad, the likes of a Ford, a Honda, a Nissan, a Volvo, a Renault, a Volkswagen, a Daikin, all of them are clients. Also, an NTPC is a client. In terms of international markets, Germany, Singapore, UAE is what they currently operate in. Geography, majority of the business domestic, single-digit export. In terms of opportunities, well, e-buses is obviously a very large opportunity in terms of even the ordering pipeline. New products like electric light CVs, we've spoken about that, and battery energy solutions. Now let's talk about the metrics itself. In terms of the profit and loss account, the top line has grown at around 20% CAGR over the last 3 years. We've seen a bit of a taper, FY24 to 25. So that's one thing you want to keep in mind. Also, I'll talk about 9-month FY26 numbers, and they don't look exactly as enthusing yet. We'll see whether Q4 execution will be strong. In terms of EBITDA, you've seen a 24% CAGR on the EBITDA, on the absolute EBITDA number. From 333 crore, it's gone to 642. Margins have gotten better from 10% to 12%. And you've seen profit CAGR at just about 11%. And that's because the debt burden is weighing down on the numbers where profitability is concerned. We give this a thumbs up because the growth has been extremely strong and it's been impressive. Whether they can sustain that growth, it seems so, but we'll try and get comfort as to whether they can do that by keeping a healthy balance sheet, and that's what it comes to. But let me look at the 9-month numbers very quickly before that. 11% revenue growth is what we've seen in the 9-month period. EBITDA roughly in around the same number, so flat on EBITDA. What we've seen is profitability has come in 8% higher. So largely, it's a very, very steady set overall in terms of the numbers, where the 9-month numbers are also concerned. But it'll be a tall ask to get from, in 9-month FY26, from 4,236 to over 6,000 crore in terms of top line. It's going to be a tall ask, and we'll see whether that plays out. Second, margin trajectory. Let's see how that has played out, and what we'll see is it operates in a very tight band in terms of margins, between the 10 to the 12% number. We give this a thumbs up as well. The tight margins ensure that there is certainty regardless of what kind of commodity cycle we're in. At least that's what we're seeing for the moment, but we'll try and analyze that further when we're speaking with management. Third piece is the balance sheet, and when you're looking at the balance sheet, you'll see equity at around 1,418 crore. That is the book value currently, which is H1 FY26. But what you're seeing on the borrowing number is 2,600 crore. So 1:2 in terms of, or 2:1 in terms of debt to equity. Now, the debt currently, excluding these liabilities, is at around 3,200 crore. So when you're looking at the debt to equity, it's actually ballooned. That's where the problem lies. They have plenty of potential to grow, but the balance sheet is the concern. Can they try to change that? What's the outlook? What are the plans? How comfortable are they? We'll understand all of that when we're speaking with management. Let's talk about cash flow now. In terms of the cash flow as well, the cash flow conversion is not happening, which is what is weighing down the numbers. There is some amount sitting in receivables, some amount sitting in inventory, due to which what we're seeing is cash flow to EBITDA conversion or EBITDA to cash flow conversion is not happening. So that's the other piece where we're slightly soft. It's a neutral on this count because there have been years in which cash flow has come through. So that's the other thing we'll keep in mind. The fifth piece is with regard to return ratios. They've been, again, in a tight band of 12 to 14%. We've seen 1 year, FY21, that year, where return ratios was at 9%. But outside of that, it's been in the 12 to 14% band. You want to be 15% plus if you're in India, right? So there is potential, but they're currently operating in that 12 to 14% band. That's why the neutral rating over there. But they're not single digit, and they're fairly stable. So that's the positive. Let's look at shareholding now. You're looking at shareholding of 68% from the promoter group, which is extremely strong, frankly. So A clear thumbs up there. FIs have a very small holding. Mind you, the free float itself is very small. It's a 13,000 crore market cap company, and therefore the free float itself is around 3 to 4,000 crore. Difficult for FIs and DIs to participate in significant fashion without moving stock price. Maybe that's why they've stayed away. That's the other piece you want to keep in mind. 30% is the public ownership in this counter. Last off, mandatory valuations. And when you're looking at valuations, we look at it trailing 12 months, 60 times both on JBM versus Electra Green. Mind you, while we've given this a neutral, this one was trading at a far superior premium to both Electra Green as well as the 60 times it currently trades at. So in that sense, you've got comfort in terms of valuation. The question is, can they turn this around in terms of execution? Okay, so that's the long and short of it. Let me bring on board, in fact, Nishant Arya, who's the Vice Chairman and Managing Director at JBM Auto, to talk to us about exactly this and what the outlook is like going forward. Nishant, let me first start off with the order book and where it stands today. You've got those orders coming in from CESL. Talk to us about what the traction is. How much of that are you winning? There was a 5,500 crore tender, I believe, this month or last month. And did you participate? What's the kind of win rate that you have?
Yeah, so currently we have an order book of close to 9,000 buses, and we have been delivering consistently to our customers. In the previous tender you are referring to, we had participated, but we saw that there was a very aggressive bidding by certain players. So we do not want to compromise on our profitability, and we already have a strong order book, which is ensuring that until FY28 we are very well protected with our deliveries. And we would be participating in tenders which are meeting our thresholds. And we are ensuring that we are creating a value which is meant to be delivered over this period of time.
Okay, I know, Nishant, it's going to be tough to quantify, but do you believe that the competitors that you're facing when these orders are, or when these tenders are coming out, are doing business at subpar margins, or are they able to do business at decent margins? Because if you're facing competition, I'm sure so are they. So I'm trying to understand whether they're targeting market share and giving away margins.
I think that wouldn't be something which I could comment on because it is their prerogative. But at least from our perspective, we could not really understand that how could anybody make margins and sustainable margins on such prices. But every company has their own strategy. So that is not our strategy.
Point taken. Okay, respect that view. With regard to growth, therefore, you've got a very, very healthy order pipeline. 9 to 10,000 buses is what you said you even have
No, I
now.
said 9,000 buses right now. It was 10,000
Correct, correct.
earlier. We are delivering consistently here.
Fair, fair, fair. So you're at 9,000 now. You have a capacity of 20,000, right? What's stopping you from executing all of them fairly quickly and ramping it up?
No, so the STUs and our retail customers have a lead time because they need to set up power infrastructure, they need to set up depots, and the power availability has to be there for meeting this. So that has a lead time basis which we deliver the buses. So there is no ambiguity and challenge with respect to the manufacturing capacity here. It is just the lead time and the whole loop which gets closed as things build up.
A lot of sense, in fact. Yes, you're right. Okay, with regard to growth itself, talk to us. You're at roughly 5,500 crore in terms of top line. I'm talking FY25. You've guided 6,000, 6,500 FY26. You're confident of getting there?
Yeah. Definitely, we'll be between 6,000 to 6,500 in this financial year. And as you
Higher end,
see,
higher end of that, would you say 6,500 comfortable?
no, that depends really because a lot of the customers would be taking deliveries in this. So we don't have any loss of revenue anywhere. At times, it just gets pushed out. That's why I had given a range because based on the readiness of the, as I mentioned, the power infrastructure and the depot readiness, the buses get delivered. So if there is a challenge at that end, then it becomes difficult for us to ensure that we deliver the buses in the given timeline. So the range, therefore, we meet the range.
That makes sense, Nishant. And what about FY27? What's the visibility there? You continue to grow at maybe 20%. Is that something that is sustainable given the kind of verticals that you have?
Yeah, definitely. We would be looking at maintaining or enhancing the growth which we have in FY26 and FY27 as well.
You're currently single digit on tooling. You're 50%, nearly 50% on OEMs, nearly 50% on auto ank. Talk to us about the traction in auto ank, Nishant, because what we are seeing in terms of the auto sales numbers, even today, extremely strong numbers, especially on the CV side, and that's where you really benefit, right? Because you are on that side of things as well. What are you seeing in terms of traction?
No, traction is very good, as you rightly mentioned, because after the GST reduction, the market is quite buoyant and has responded very strongly. And we are really seeing that there's a very good uptake. So even in Q3, you've seen that our numbers have grown quite substantially in the autocom segment, and in Q4 also, we would be seeing similar growth.
But then, Nishant, you're guiding for the same top line despite visibly better signs of growth. I'm trying to understand what am I missing here?
No, because Q1 and Q2 were not as strong in this year,
Okay.
and
Okay.
Q3 and Q4 are compensating for Q1 and Q2 as well.
So what is the kind of growth that you're penciling in on the auto component side of things? Say FY27, say FY26, you normalize because H1 was difficult, H2 is better. Now FY27, you'll be materially better, right? Because the tailwind will likely continue. What's the kind of growth you're penciling in only on the auto component side?
Yeah, we are targeting about 14 to 15% on the auto component side, but we are yet to receive our customer outlook because the number of launches will be increased in this year. So competition will also intensify amongst OEMs because a lot of models are getting launched. But at the same time, uh, how is the market responding, and how is the other people looking at the budget as well as the next year's outlook? I think will become way more clearer in the next couple of months.
Let me talk about the third vertical you have, which currently isn't present in the top line numbers which I presented, which is the battery energy storage solutions business. Uh, how is that ramping up, and how quickly can it start impacting your revenue number? Give us a sense of that.
No, so as you know, we already have a strong order book of 3 gigawatt hour plus
Yeah.
on the battery energy storage side. And there we would start delivering the products from the second half of next financial year.
So H2 FY27 is when that comes through. And what's the kind of revenue recognition? How quickly can revenue start impacting your top line number, and how much will it be? Say FY27, FY28.
FY27, FY28, we would be looking at 5 to 10% coming from the battery energy storage business.
Okay, all right. Point taken. And so basically 20 to 25% growth over the next couple of years. 5 to 10% of that coming, maybe 5% FY27, 10% FY28. Is that the right way to kind of think of the numbers?
Yes, yes, in that range, correct.
And are the margins materially better over there? So, or does your margin range continue to be the 10 to 12% number which you've been clocking traditionally?
Yeah, so we are looking at enhancing our margins constantly. If you see that the PAT margins as well as the EBITDA margins and the absolute growth is consistent, and we are looking to really see that how are we focusing on FATR, the fixed asset turnover, because and ensure that we are sweating our assets consistently, and that's the reason why the depreciation percentage is also going down constantly. So I think these are few key critical parameters, and we are focusing on cash flow, so generating cash in the system.
So you'll be closer to 10,000 crore in terms of top line FY28, if I'm getting this right, if I'm getting the math right, and you'll likely be at around a 12% margin number at the higher end of the band, basis what you're doing today. Maybe you'll be higher than that. Is that the right way to think of the business? You'll be doing around 1,200 crore of EBITDA.
So we will be coming out with exact numbers for the next financial year and upcoming financial years in next couple of months. But definitely we will be looking at clocking 15 to 20% growth in our business on a constant basis.
Oh, but then you're adding battery energy, right? So that should add to your numbers. So I got to 20-25% basis the battery energy storage solutions plus the auto ank growing at 15% plus the delivery with regard to buses. So would that not happen?
No, that would happen, but the numbers would get crystallized once the OEMs in our auto ank business also define their growth trajectory. The 5% of BESS, 5 to 10% of BESS is definitely going to happen. There's no question about that. On the auto ank business, we are very confident and looking at good growth. But at the same time, we are now crystallizing our budgets for the next year.
Nishant, we've made very good ground. There are three things that I want to know. Debt, capex, and cash flow. What's playing out on these three? Because these three are possibly the concerns. If capex, there's no capex required, that just puts capex out of the way. What about debt and what about cash flow?
No, so we have been really focused on ensuring that we are maintaining our deliveries to our customers, and this year had been quite volatile in terms of the supply chains due to the geopolitical issues worldwide. So we had tried to see that we had created larger inventories to ensure there are no disruptions in our business, which weren't there today. So it will get normalized by the end of this financial year on the debt side of it, especially short term, and on cash flows partially by the end of this year, because again all that inventory will get liquidated which we had created by Q4 of this financial year and Q1 of next financial year.
Excellent, Nishant. This has been extremely productive. Thank you so much for coming in and speaking with us. It also gives us good clarity with regard to the top line guidance. You don't do con calls, so I'd love to have you again post Q4 to try and get a perspective of what's in store for the next couple of years, because you are non-committal on a couple of things. So I'll try and get that perspective from you.
We like to commit with utmost clarity, so that's what we try and build in. So yes, definitely we'll be sharing that with you soon. Yes.
Of course. Thank you so much, Nishant. This has been a pleasure. And viewers, that's all the time we have on this edition of the show. Stay tuned to ET Now. More action on the other side.